Hey, good morning, everyone. Marty Missouri here, the 12th of February, 2022, with your weekly macro update. Well, if I shared and illustrated all that I'd like to this morning, we'd be doing this far too long and you'd give up far before the end. So I'm going to try to do what I usually try to do, and that's be succinct, not spend all day making a few points. There is a plethora of data, signals, mixed signals, trends, counter trends, just across macro, across markets and so forth that we can get into. But I'm going to keep it simple and go through the charts that I've dialed up that are inputs to our macro index. I definitely want to get into some charts on equities with you. We'll go ahead and skip currencies and precious metals. I'll circle back maybe in the next week or so with information there. It is interesting, the action, particularly in Friday in gold and silver, on the news that the U.S. National Security Advisor and team see concerning odds that Russia actually will enter with military force Ukraine next week, as early as Tuesday. That is consistent with, as I wrote yesterday on the blog, our partner in geopolitical research, BCA, with their view. They upped their odds from 50% to 75% that Russia is going to invade Ukraine. They think it'll be relatively small scale relative to the potential, and therefore will have certainly a negative, and you could see a preview of that on Friday, but albeit brief in the context of the year 2022 hit to global markets. I'm not going to speculate either way. I do know that the news when I got up this morning was that the U.S. ordered the folks at the embassy in Kiev to come home and are strongly suggesting that any Americans in Ukraine get out in the next 48 hours. On the flip side, and something that sounds positive from the headlines, the president later this morning is going to be talking with Vladimir Putin. In fact, should be happening right now if it hasn't already happened. And there's various other conversations between Russia and officials from other countries, Europe and the U.S. I understand that the French president and Putin are also talking today. So, we kind of get this sense that if they're chatting about this, that maybe they'll emerge from those talks and say that Russia will put a hiatus on any incursion. The thing about that is that they are vehemently denying that they're going to invade, notwithstanding the fact that they have, over 100,000 troops, presumably prepared to do so. So how this plays out and whether it's, an invasion across the border or inciting activity within and so forth, there's lots that can happen. So it's going to be very fluid. Arguably has the markets nervous, as I mentioned. That would probably explain the big jump in gold on Friday. That's a not small position for us for a lot of reasons going forward, but really more just fundamental macro reasons. And that's the view that inflation is going to be structural, sticky, if you will, for a longer period of time. Notwithstanding our view that it is going to abate, I keep making that point often on the blog, that when you look at base effects relative to a year ago levels as we move out the next few months, when you look at supply chain bottlenecks relieving, and we are seeing that in many of the surveys, still a real problem for an extended period of time, but some relief there. When you look at the complexion and the nature of the inflation that's there, huge inflation in things like durable goods, and that's bound to come off the boil. And then when it does, and maybe we settle down to something between 3 and 5% mid-year, then the people will come out of the woodwork and say, "See, we told you, there's not inflation." We think that's the wrong narrative, and that's our objective view of lots of forces that I've spent a ton of time over the last year or so explaining, and some of them have, nothing to do with coronavirus and just have to do with society and structural changes and populism and deglobalization and these kinds of things. And that gives us some direction in terms of how to allocate assets long term. I will say that there has been a real regime shift in terms of, let's just say what will work going forward. And I think over the next multiple years, I think we're entering a phase where value will highly likely outperform growth in terms of, equity characteristics. Foreign will likely outperform U.S. for an extended period going forward. And I think there's, evidence that we may be just now entering the next commodity supercycle. None of these things are linear. They will come in fits and starts. We also think that the ice is thin, using my favorite metaphor, across markets, and that ice breaking, particularly in the U.S. equity market, which we think is very exposed, when you consider the fact that U.S. households have more in stocks than they ever have, something serious there could literally bring on recession in kind of a reflexive fashion. And then that would bring on a period of disinflation. And, we could get into midterm elections and what one party's incentives might be versus another in terms of fiscal stimulus and so on. So there's just so much that we can get into the weeds. Suffice to say that there is this regime shift or regimes shift. There is real clarity on a long-term basis, and I didn't even mention the ESG or the big global push to going renewable energy and what that means for the price of copper and the price of fossil fuels and everything else going forward too. That's also huge in our narrative. But none of this is going to happen in a straight line. We are going to be looking at a period of, I think, extreme volatility, certainly relative to what people have grown accustomed to, particularly last year, right? And that's okay. Volatility is just part and parcel to being in markets. It's okay if you recognize the risk, you hedge in the right way, and you won't be able to hedge out, the mid to high single, low double digit moves in the market and still make money in our view. You'd be spending too much money in options premium. But we can certainly hedge against, the 2008 and the 2000 to 2003 style collapses. And those are the things we're worried about here. And we can be in a position doing so to take full advantage of cheaper prices if and when those things occur. But at the end of the day, we don't know that they're going to occur. We just know that the risk is there. And it's risk that we think, at least absolutely on behalf of our clients, should be hedged. Okay, so in front of you is our PWA index, and as you can see, it's rolling over, right? That would be just the rate of economic growth. We're still a long ways from recession, but 29.79 was our last reading after being flat for a week. And so, economic data does not look all that encouraging while inflation continues to ramp up. So, a lot of people are criticizing the Fed right now. They're saying, the Fed is tightening into a slowing economy. I get it. And lots of news over, the very weak University of Michigan preliminary sentiment reading for January that just came out, I think yesterday. And they're saying, wow, the consumer's already feeling like they're in the doldrums and we're going to raise their borrowing costs and so on and so forth. But as you'll see in some of the data, it's very mixed. We've got poor sentiment, but we have, very high hiring expectations among small businesses, and small businesses hire most of Americans, right? We have 11 million job openings. That's not part and parcel to an economy that's about to roll into a recession. And then when you get into the particulars of these sentiment surveys, like the University of Michigan, you find out that it's largely inflation that has people upset, right? So then you've got, the Fed is utterly and exceedingly concerned about financial markets. They, frankly, forgive me, but they completely blew it. They had many options, many times over the last this expansion, this bull market that I, by the way, am not in the camp that says it ended in February, March of 2020 because we had a 35% dip. That really did nothing in terms of what bear markets and recessions would normally do. We're still in the old bull market. And there was been many opportunities along the way for the Fed to tighten monetary policy. But the minute they tried and the markets cracked, and you'll see some of that here in a minute, they got scared and they turned tail and they took care of markets, right? And fueled more populist sentiment when you look at the gap between the rich and the poor. So now, though, you've got real inflation. And now the consumer is not worrying about their 401k as much as they're worrying about the fact that while they're getting pay increases, it's not keeping pace with inflation. So we'll see how that plays out because the Fed is going to have to be more aggressive and the market's going to hate it, as we've seen. The market will price something in. The Fed will be a little more benign than maybe what the market priced in. We'll get these huge rallies and so on and so forth. But at the end of the day, if they're really going to do a serious number on inflation, it's going to do a serious number on the equity markets in the U.S. To what degree are they going to allow that to happen? I keep writing on their blog. They'll do it till the market cracks. Well, how big is that crack going to be? Before they jump in, last time they breached the Federal Reserve Act and bought junk bonds. That the mechanism that they created to do that, nothing to keep it from buying equities. I think now with inflation and so forth, if that is ultimately going to be the Fed put, so to speak, put option, I think it's lower than I would have thought a year ago. So I think they have to allow for some market pain. So folks, let me stop that there, run through the charts, get to the technicals, and then let you get on with your weekend. Okay, so mortgage purchase applications, this was happening here amid rising mortgage rates. I think we're like 3.85. You kind of that panic. Mortgage rates are going up. We gotta do it, right? We gotta get that mortgage. Well, forget that one. That one fell off a cliff. You can see the rate of change was down 10%. Refinances were down as well. So yes, higher mortgage rates are having an impact on mortgage applications for sure. I mentioned that consumer confidence. This is that University of Michigan read. Oof. How far does that go back, right? Yeah, quite a ways, right? So that's not good. The Langer Weekly is not good. When this comes out, Conference Board, it's going to be not good. They ask different questions and so forth, so this one's held up better. But this doesn't look good in a consumption-driven economy. But again, you look under the surface and you say, does this scream recession like back here? Well, no, clearly. Consumers are still spending enough money and they've got like $2 trillion in savings, which makes a lot of economists feel pretty good. Banks are lending money. They're not tightening conditions at this point in terms of, if you look at senior loan officer surveys, they're actually loosening up on the underwriting standards and so forth. So, this could morph into something bad and people could stop spending ultimately. But right now it's what I talked about a second ago, more so. Again, you don't have recessionary conditions when you have way under 300,000 jobless claims in a week and you have continuing claims continuing to fall, right? This is what recession looks like, right? These are recessions, these red shaded areas. This is what you're looking at, right? This is really low jobless claims. And quits rates are really high, the people who are actually quitting their jobs. Again, those aren't part and parcel to recessionary conditions. They're part and parcel to expansionary conditions. So again, those mixed signals that I keep talking about. Small business optimism. Okay, that looks recessionary, right? That's falling off a cliff. And here's your recession look, right? Well, that's true. But again, it's more about lack of the ability to find qualified workers. It's about, inflation input costs, because even though this ticked down a little bit, hiring plans are still, at all-time record highs, off of this high right here. So this is not, anything right here when you look at the largest employer of Americans saying we need to hire a lot of Americans. That does not suggest that business is terrible, right? Price of copper, we just kept flagging up. Remember we were looking at these this whole way, from 2020, And so that's a pretty good pattern. And then finally it failed, right? It failed right here. And remember, folks, I was saying as I would show this every week, and we love it, in our portfolio because we're in both copper futures and in the miners in a couple of different places. But I'm saying in here, this is unsustainable. We are going to feel some pain. And, we're drawing lines down in here, and sure enough, it hit one of those resistant levels right on the nose and then came back up. Well, here we are breaking out of what had been pretty stiff resistance, and we're very bullish on copper, certainly the need for copper for many years to come. I featured, I believe, in the written blog last week, the comments of the Freeport-McMoRan's CEO. And, he's talking about political pressures in places like Chile and Peru, which that's where 40% of the world's copper comes from. And canceling or postponing, potential new mining operations in that region because of that political pressure. And so we'll see how all that plays out. That political pressure, of course, if it's going to do a number on production or raise the cost of production in a market where we can't get enough copper to meet these green energy mandates, it's going to push the price of copper higher. Just no ifs, ands, or buts about it, but not in a straight line. The Baltic Dry Index, pushing dry bulk goods across the oceans, really was dropping. And I'd say, slow down in the Chinese economy probably. Some hope relative to inflation. Well, quite the spike up here over the last few days. So worth showing. They didn't change any scores in our index, but something to pay attention to for sure. And this isn't part of our index, but I look at it anyway. And if this is the cost of shipping a 40-foot container from Shanghai to LA, you can see that moving back up again. Again, that kind of gets in the face of my narrative that we're going to see a little bit of a cooling. I would also add that the way the government data measures housing rents, number one, is just flat wrong in my view and way understates it, but it does state it in a lag. So I'm reading, from some economists that say that actually is going to start showing up more in the numbers too. I still think we'll get slower rate of change in inflation once we get into, March, April, May, June. But, we'll see to what degree that actually is. It may not be quite the relief that we might otherwise anticipate. Okay, folks, so those are the charts. Could have been more, but I've been rambling so far already. I'm glad that's all for now. On that, let's jump into the S&P 500 daily chart. So we've had the breach of the 200-day moving average. We had a bear flag pattern. It looked so classic, but it didn't play out. Nice big bounce off of that. Came back through the 200-day moving average. Very encouraging. Well, folks, this is the opposite of encouraging, right? Closing right here with this big candle below the 200-day moving average. Sloping down here on the 50 and a flattening out of the 200-day moving average. From a technician's perspective, boy, you couldn't ask for less. If you're a bear, you couldn't ask for more. So that's not a good look right there. Of course, we do know what Friday was all about, and presumably if we hear over the weekend that Russia's pulling troops away from Ukraine, well then, of course, very strong odds that's gonna push itself up higher. Now, let me throw a wrench into that. Should something occur geopolitically, globally, that really gets the world panicky, right? That, on balance, will weigh on economic data. If it lasts for any period of time, right? It'll slow activity, and if it slows activity, well then that should slow some of these pressures that would have the Fed, raising interest rates, some think by 0.5% next month's meeting. Fed Governor Bullard said he wants to see a 1% increase by July, and that's what got the market upset on Thursday. But if you have big global angst, well, then the Fed, can justify maybe backing off a little bit. Maybe that'll have some a weakening impact on the economy. And so remedying that, which of course we all want, of course, these geopolitical risks, the one in particular that we're talking about, well, that's what we should be hoping and praying for, of course. Then that could create some optimism and so on. And what does that mean? That means no alleviation whatsoever of the pressure on the Fed. And that's better than the opposite for sure. But ultimately, you get a nice relief rally, and then you say there's nothing in the way bigger rate increases than what equities have priced in, and then of course you roll right back over. So things to think about, at least things that we here at PWA are thinking about. As that composite index looks even worse, you could, I'd call this a failed bear flag. You can only take these out so far. Somebody who's really wants to make a point or incorrectly illustrate something, maybe they're bearish, might try to put a flag around that. That's just too far out there for the flag itself. So anyway, so that pattern is defunct, I would say, but losing the 200-day moving average, with momentum and some, and then coming back, and you watch, I'm sure we can draw a line right across there. Well, let's say right across there, right? And where you're jumping right on resistance, which became support. Once broken becomes resistance, and then you got the 200-day moving average above that. You got a falling 50-day moving average above that. Some people call this going below that the death cross, and I could show you some patterns that might give that credence. That's not an important one to me. But the shape of these are, and where the price lies below that shape. So this just really doesn't look good, folks. And you come down and you break through that resistance, and there's really not much protecting you below for quite some ways. So this market, as I say, portfolio managers should be hedging against something big to the downside. You're not gonna protect anybody from these kind of moves, but you can protect people from these monster moves further down. I did want to throw one more thing. This is from a credit market barometer that we created and tracked, but this is the 2-year Treasury yield, and this is the upper bound of the Fed funds rate, quartered 0 to 0.25%. Notice how instructive the 2-year yield is as an indicator of what the Fed's about to do, right? So here is the 2-year yield declining, rising, and then the Fed raising a bunch of times going into the 2000 recession here. And then here it is rolling over before the Fed starts cutting. Here it is up before the Fed starts increasing, rolling over before the Fed starts cutting, rising, a year before the Fed starts increasing, and then rolling over before it starts decreasing. This Fed is by definition late to the party, behind the curve, however you want to say it, and has a lot of catching up to do. Hence commentary from folks like James Bullard on Thursday, which roiled markets. Now I want to pull from weekly macro exercise. We're not going to go through all of it, but I want to show you some of the market stuff in there that we've been tracking for years and years. So I want to start with a long-term look at this 200-day moving average going all the way back, 30 years. This will look familiar to you here if you read the blog. So, we've had this extended period where just this really big gap right here between price and the blue line, the 200-day moving average, right? You just don't find that, very often. Here you could argue that. And that was 1996. There we had the Asia currency crisis was getting underway back in here. We had a 20% decline right in here when Russia defaulted and the world's biggest hedge fund turned upside down and so on. But when you roll over from here, that's what we're looking for. When you roll over, remember I said that 200-day moving average is flattening out. And that's a sign that something potentially really bad is coming. So we're not there yet, right? But here when we zero in, you can see that, that we're starting to look that way, right? Now, breaking through, this is the S&P 500, breaking through the 200-day moving average, as I said earlier, and then failing that, at least as of Friday, is just anything but a good sign, right? You can see here back in 2018 when, we went through the 50 rolled over, broke down, tested, lost it. That was just like 19.9% decline, right? And what I did here, and I did this on the written blog, is I circled all the times from the last recession that we broke through the 200-day moving average, circled in red where it turned into a double-digit decline, in green where it didn't, right? So there were 9 occurrences up until currently. This would be the 10th. And in 5 of those occurrences, we had a double-digit decline, and in 4 of them, it was just a test, and it was a good buying opportunity, right? Well, I thought I'd go ahead and show you that up against the Fed balance sheet. So why the Fed balance sheet? Because this represents the Fed doing quantitative easing or money printing. When you hear that they're printing $120 billion a month, what they're doing is they're buying securities. So specifically now, post-COVID, there was some corporate debt in here, but right now it's mortgage-backed securities and U.S. Treasuries, right? So when we go through here and we look, okay, so here we had, this was 2010, that was like a 10 to 15% correction if I recall. Look what was happening here to the Fed balance sheet. They weren't really printing money, right? It was flat. So they were doing some QE and they stopped it right in here, right? Here it actually declined a little bit. And that was almost a bear market. That was a 19% correction in 2011. That was during the European debt crisis and so on. Here in 2012, here we did have the Fed, reducing the size of its balance sheet, albeit lightly. But nevertheless, that did not morph into something, and largely because you can see right in here, it was anticipated that the Fed was going to engage and start doing more QE, right? And then we had 2014. We had a test that was successful, and on balance, the Fed was still very accommodating. But then the Fed kind of pulled the punch bowl a little bit from 2014 to 2016. During that period, from here to here, we had a 16% correction in the S&P 500. Then we come along here to 2018, and this is where Jerome Powell, was feeling his oats and said, we got to let this balance sheet, we got to shrink this balance sheet, we got to let it run off, and so on. And what did that deliver in the fourth quarter of 2018? There were other issues too. The trade war was hot and heavy in here as well. It delivered a 19.9% correction in stocks. And then, of course, he turned tail very quickly, had a little bit of a test there. And then what's interesting is in August of 2019, folks, our macro index and our data said the bull market's over, or bull market conditions are over at that point. So we engaged, we had a great time, like most people did all through here. But right in here, we instituted an options collar. We had a really, really good year up to this point. We said, okay, let's go ahead and maybe cap some of those gains. We still have a little bit of upside, but if something breaks in here, all hell's probably going to break loose based on our assessment of general conditions. But I also was preaching ad nauseum on the blog that I'm probably going to look really stupid right here, because even though on the surface, we had like 3.5% unemployment and everybody was saying the world was good, that was not our assessment. And by the way, while Chairman Powell was up there talking about how great the economy is, if you read the Fed's quarterly reports from their own economists, they were as concerned as we were about credit risk, in particular on the corporate space. So I literally said in here that, the Fed sees what we see. So they're probably going to try to get in front of the next recession. And we weren't forecasting anything bad in 2020. I mean, it was a U.S. election coming up, Japanese Summer Olympics, celebrations in China, century celebration and things for the Communist Party. So you knew these big governments were going to stimulate their economy. Our concern was, being fiduciary for our clients' monies, was that if something happens, it's going to be, ugly. And sure enough, something happened, right? But that something that happened, because it was COVID, gave the green light for them to print, and create trillions upon trillions of stimulus and exacerbate structurally inflationary forces and put us in this fine mess we find ourselves in, where the Fed is really boxed in right here, right? But so this was swift. We were hedged. It did happen in a period where the Fed was being accommodative, but bull market conditions were over in our view. And so, but then look at this unbelievable epic ramp up. That's what I'm talking about, right? During that time period, we went from, 4 trillion to almost 9 trillion and rising, right? So my point here is, with the exception of this one, all of these red circles here, big double-digit declines, came amid a period where the Fed was not ramping up the balance sheet, where the Fed was either on the sidelines in terms of stimulus or actually withdrawing stimulus, right? Well, because of inflation, we absolutely know they're going to withdraw stimulus. So good chance that that's going to turn into a red circle, right? We almost got to a double-digit decline. The S&P got to like 19% for the NASDAQ. And so that's, that's something, along with all the other risks that we talked about, something to be concerned about. And to manage accordingly. Long term, you can get in this trend indicator here that we created a few years ago. What I did is I chart the 20 through the 60-week moving averages, slower moving. The 20 is shorter term, so it's faster than the 60, of course. But then, it's as these things were going up and beginning to roll over, was it actionable? Well, from a pure macro perspective, yes and yes, right? But here as it was rolling over, no. Even in 2018, we were sanguine, that whole time. We talked to a lot of clients back then. I said, listen, this is a correction within the context of an ongoing bull market. Well, here it wasn't, but this got saved by that massive ramp up in the Fed balance sheet. So that massive ramp up really still explains this, right? Were it not for that, I think we'd be deep in the throes, maybe finally now coming out of the worst recession in history, literally. So we have to put this in context. Right now, though, you would say, no, this is still okay. You can still be in stocks, which we are. All these other reasons that I keep noting says, yes, let's do that, but let's be in the stocks outside of the froth. Let's be in the stocks and places in the world that show real value and would do well in a weaker dollar environment for the next multiple years, in our view. So, folks, I'm going to stop myself right there. I've got more dialed up, but this is too long for one video. But I think I've made my point. That is that macro conditions are not recessionary, right? So this is not the kind of scenario where you would just abandon markets, right? Yes, the Fed is going to be tightening up on monetary conditions. Also, to play the other side of that, the consumer has $2 trillion in savings and banks are willing to lend right now, right? So that should offset, the economic impact of things. The market itself, under the surface, the market internals look very concerning, particularly in the U.S. We think there is massive opportunity for patient long-term investors outside the U.S., places like Latin America, for example, in commodities, like I keep saying as well. But none of this is going to happen in a straight line. It's going to be a very jagged line across asset classes. And so folks expect volatility. You can't invest without it if you want to earn more than the rate of inflation going forward. And for lots of reasons, and several we didn't even get into today, it's going to be a volatile period. And we'll continue to do the work day in and day out. Thank you, as always, for watching and listening, and good luck for your team on Sunday at the Super Bowl. Have a good one. Bye-bye.